Today, the cryptocurrency landscape is witnessing pivotal changes impacting investors globally. From Bitcoin's struggle to maintain its value to the advancing regulatory framework with the Clarity Act, the market is in flux. Here are today's top 10 stories you need to know. The cryptocurrency sector is witnessing a significant expansion in tokenized equities. Recently, BitGet Wallet added 130 tokenized stocks, marking a notable shift in the crypto landscape. This move highlights the growing trend of linking traditional financial assets with blockchain technology. As tokenization becomes more prevalent, investors can access equities like never before, utilizing digital wallets to trade these assets seamlessly. This development is essential as it demonstrates that cryptocurrencies are not limited to native tokens. Instead, they are increasingly serving as a bridge to traditional financial markets. The inclusion of stocks, treasuries, and other financial instruments on the blockchain could revolutionize how assets are traded and settled. As more platforms adopt tokenization, infrastructure providers may emerge as the primary beneficiaries of this trend. The future appears promising as the lines between traditional finance and cryptocurrency continue to blur. Recent market reports indicate that whale activity is significantly influencing short-term volatility in cryptocurrencies. Large holders, or whales, are capable of causing abrupt price swings through their trading behavior. This phenomenon underscores the fragile state of the current market, where liquidity is concentrated among a few major players. When whales decide to de-risk their positions, the market often overreacts, leading to sharp price declines. Conversely, when they accumulate assets, prices can rebound swiftly. This volatility is a defining characteristic of the cryptocurrency market, which still experiences more drastic price movements compared to traditional assets. The presence of institutional investors adds another layer of complexity, as their trading strategies can further amplify these fluctuations. As the market matures, understanding the behavior of these whales will become increasingly critical for traders and investors alike. In the dynamic world of cryptocurrency, stablecoins are emerging as the liquidity backbone of the entire market. Recent reports indicate that Tether, a major stablecoin, has approximately $189.69 billion in circulation. This figure reinforces the critical role stablecoins play in trading, settlement, and DeFi activities. They serve as the primary quote currency for much of the crypto trading ecosystem. Additionally, stablecoins provide a vital bridge between fiat currencies and on-chain markets, facilitating smoother transactions. Their significance extends into decentralized finance, where they act as a crucial collateral layer. A growing supply of stablecoins typically signals more deployable capital within the market. Historically, an increase in stablecoin circulation has preceded higher trading activity and deeper liquidity. As the landscape evolves, the reliance on stablecoins is likely to continue, shaping how traders and investors interact with digital assets. Ethereum is once again capturing the attention of institutional investors, with recent market analysis showing ETH trading around the low $20,100 and significant inflows reported. This renewed interest is crucial, as Ethereum serves as a foundational layer for numerous applications, including decentralized finance, stablecoins, and tokenization. Its programmable nature allows for extensive use cases, making it a pivotal asset in the cryptocurrency ecosystem. Historically, Ethereum has often lagged behind Bitcoin during periods of market uncertainty, yet it has consistently demonstrated resilience. As traders seek higher-risk assets with deeper liquidity, ETH tends to catch up quickly. If this trend of capital shifting towards Ethereum continues, it could catalyze a broader resurgence in decentralized finance and Layer 2 solutions, enhancing Ethereum's utility and adoption. The implications for market dynamics could be profound, creating fresh opportunities for investors looking to diversify their portfolios and capitalize on emerging technologies. Analysts predict that sustained institutional interest may push Ethereum prices higher in the coming months. The Clarity Act is making significant progress in the legislative process, having recently advanced through the Senate Banking Committee with a 15-9 vote. This regulatory development is crucial as the cryptocurrency market has long grappled with uncertainty surrounding asset classifications and jurisdiction. The bill seeks to clarify what constitutes a security versus a commodity, establishing comprehensive guidelines for exchanges and tokens like XRP. By providing clearer regulations, the Clarity Act is expected to encourage greater institutional participation in the market, despite potential increases in compliance costs for businesses. Large exchanges and compliant decentralized finance infrastructures are likely to be the primary beneficiaries of this legislation. Most importantly, the Clarity Act could help alleviate the pervasive uncertainty that has hindered the market's growth, fostering a more stable environment for innovation. As the legislative process unfolds, industry stakeholders are closely monitoring how this bill will fundamentally reshape cryptocurrency regulation in the United States, paving the way for a more robust and reliable market framework. The flow of assets into Bitcoin exchange-traded funds, ETFs, is currently a dominant factor influencing market sentiment. Recent reports indicate notable outflows of approximately $648 million, signaling a potential shift in investor confidence. This trend comes amid a broader market environment where cryptocurrency prices have shown volatility, reflecting concerns over regulatory scrutiny and macroeconomic uncertainties. ETF flows are now considered a crucial liquidity signal in the cryptocurrency market, as they provide insight into institutional and retail investor sentiment. Strong inflows typically indicate a healthy demand and stronger price support, while outflows can lead to de-risking and short-term pressure on prices. This behavior has transformed the ETF market into a real-time sentiment dashboard for traders. When flows are robust, Bitcoin tends to better absorb macroeconomic noise, while weakened flows can render even positive news ineffective. As such, monitoring ETF flows will remain vital for understanding shifts in market sentiment. In the coming weeks, investors should closely assess these metrics to better navigate potential price movements and adjust trading strategies accordingly. Bitcoin remains in a critical price range, attempting to hold the $77K to $81 zone. Recent trading activity has seen BTC fluctuate within the mid to high $70,000. This price zone is crucial as it often determines whether the market will shift into a risk-on or risk-off mode. Observers note that Bitcoin has acted as a key liquidity gauge for the entire cryptocurrency market. While there is evidence of buying activity, the conviction among buyers is not yet strong enough for a decisive breakout. The market is treating each dip as a test of institutional demand, and a stable price above this range could provide the necessary momentum for altcoins to rally. However, if Bitcoin fails to maintain this support, it could lead to a rapid shift toward capital preservation strategies among traders. The next few trading sessions will be critical in determining Bitcoin's trajectory, and investors are closely monitoring this key price level. Blockchain intelligence firm Chainalysis is continuing to play a crucial role in the cryptocurrency landscape, particularly following recent enforcement events that have raised eyebrows across the financial sector. With the rise of digital currencies, concerns over fraud and money laundering have intensified, prompting regulatory bodies to step up their oversight. Chainalysis has been at the forefront of analyzing blockchain data, offering services that detect fraudulent activities while ensuring compliance with international regulations. This focus is essential for building trust within the market, especially as institutional participation grows and more investors look to enter the space. The ability to trace transactions and identify illicit activities is critical for the sustainability of cryptocurrency, as it helps to mitigate risks associated with digital assets. As enforcement actions increase, the demand for robust blockchain intelligence will likely rise, creating opportunities for companies that can provide these insights. Looking ahead, the role of blockchain intelligence will be paramount in shaping the future of cryptocurrency, providing a foundation for a safer and more compliant ecosystem that encourages innovation while safeguarding participants. As the cryptocurrency market evolves, institutional interest is increasingly focused on both Bitcoin and Ethereum. Recent data highlights a growing trend among institutions looking to diversify their holdings beyond Bitcoin. This shift is significant as Ethereum continues to serve as a foundational layer for various decentralized applications in finance, often referred to as DeFi. The recent surge in trading activity has seen Ethereum re-enter the spotlight, with substantial inflows indicating a renewed belief in its potential. Institutions are recognizing the value of Ethereum's programmable capabilities, which enable smart contracts and foster innovation across a diverse ecosystem of digital assets. This trend suggests that institutional investors may play an even larger role in shaping the future of both Bitcoin and Ethereum as the market matures. Increased institutional participation could lead to heightened price stability and growth potential for both assets, fostering greater confidence among retail investors. Additionally, as more traditional financial entities embrace cryptocurrencies, regulatory bodies may become more accommodating, further legitimizing the market. Looking ahead, the trajectory of institutional investment in Ethereum could redefine its standing in the cryptocurrency landscape, paving the way for its integration into mainstream financial systems. The cryptocurrency market is on the brink of significant regulatory changes with the advancement of the Clarity Act in the Senate. This legislation aims to clarify the classification of digital assets, addressing long-standing ambiguities regarding what constitutes a security or a commodity. The recent 15-9 vote in the Senate Banking Committee marks a pivotal moment for the industry, signaling a growing recognition of the need for regulation. Historically, the lack of clear guidelines has hindered institutional investment and left many projects in legal limbo. By establishing a framework, the Clarity Act could encourage more traditional financial institutions to enter the cryptocurrency space, fostering innovation and enhancing market stability. This clarity is particularly crucial as the market has been grappling with uncertainty for years, with many investors wary of potential legal repercussions. Exchanges and projects that align with the new regulations may find themselves better positioned to thrive in a competitive environment, potentially attracting new capital and fostering consumer trust. As the legislative process unfolds, stakeholders are keenly observing how these changes will impact market dynamics and investor strategies. The future of cryptocurrency regulation appears to be on the cusp of transformation, with the potential to reshape the landscape for years to come. The successful passage of the Clarity Act could usher in a new era of legitimacy and growth for the entire industry. Thank you for tuning in to today's top stories in cryptocurrency. Which of these developments surprised you the most? Don't forget to like, subscribe, and stay updated on future news.